See, now, this all begs another interesting question. Are America's biggest banks simply still too big to fail, and taxpayers still on the hook? Joining us now, two distinguished members of the House Financial Services Committee. Brad Sherman's a Democrat from California. David Schweiker's a Republican from Arizona. Welcome, gentlemen. Brad Sherman, what would you do right now? What would your first, if you could wave a magic wand, what would you do, Brad?
As far as the issue of too big to fail, I think too big to fail is too big to exist. You know, even a protozoa, when it gets to a certain size, it's able to divide, and the resulting two cells are considerably healthier. Given the fact that most of the folks up on Wall Street are considerably smarter than protozoa, you'd think they'd be able to do the same. The reason we need to do that is we never again want a situation where a bank can call Washington and say, you better bail us out, because if we're going down, we're taking the economy with us. And we never want to be in a situation where any one bank has a lower cost of capital because investors believe that it has a safety net, because if it ever gets in trouble, it can seek a bailout in Washington. All banks ought to be part of a capitalist financial system.
Let me get Dave Schweiker back in. I think Brad Sherman's making some good points, Dave Schweiker. And I want, you know, Richard Fisher, the president of the Dallas Fed, has said time and time again, and I think he said it today or yesterday or whenever, he said it on our show, banks that are too big to fail, and there's still a bunch of them, as you know, if they're too big to fail, they're too big. And if they're too big, they ought to be broken up. Dave Schweiker, what's your thought on that?
And in many ways, this is our own fault, and those of us who are policymakers. Look, I actually believe some of these banks are too big. But the way you deal with that is competition. You actually design a regulatory environment so the mid-sized, mid-point, mid-market banks grow, take market share, because the big banks cannot compete and reflect consumer demand as quickly. Create a dynamic, competitive market, and that's how you end up with right-sizing.
All right, let me bring in an old friend, Bill Isaac. He's former Federal Deposit Insurance Corporation chairman. He's now chairman of Fifth Third Bancorp. Bill Isaac, though, really, I think Brad Sherman is correct. There really isn't competition. The largest gigantic banks, Citibank, of course, J.P. Morgan, those guys do get cheaper money. Those guys are too big to fail. If they are taking outside risks the way J.P. Morgan did, and they didn't have the controls, aren't taxpayers on the hook? It's not in the Dodd-Frank bill reform. What are we going to do, Bill Isaac?
Well, I would agree that we have a number of banks in the country that are just too big to fail, because they generally don't get in trouble alone, and they get in trouble at the same time, and they comprise about half the economy, about half the financial system. So we really can't let these banks fail right now. What we do about it is a very different issue. I frankly think that if we had the right regulatory policies in place, these banks wouldn't dominate the way they do now. I also think that there are some things that the regulators can do to make the market impose more discipline on these banks.
Bill, wouldn't you agree the fastest way to getting right sizing, in market share would be actually making sure we have a regulatory environment that creates a fairly dynamic, competitive environment, so some of those structural benefits that a big bank gets, they lose because people nipping at their heels in the growth.
Dave, if I can respond to that, the key to being successful in the financial world is having a low cost of capital, being able to take significant upside risks, but still have a low cost of capital. And if you're too big to fail, you get the low cost of capital, because
Brad,
you're able to turn to your investors, turn to your creditors and say, if we go under, we've got the Treasury Department on speed dial. They'll have to bail us out. They can't live with another Lehman Brothers. They can't live with another depression.
That's ultimately our fault. If we make it very clear you don't get a bailout, you engage in dumb acts, the market actually raises your cost of capital, creating a competitive edge for those companies that are managing themselves.
We haven't convinced the markets that we would say no. We should have said no last time.
I'm sorry, Brad. Let me just get
we agree on that.
Bill Isaac, former FDIC chairman. Bill, right now you have this void. The Federal Reserve has said that the Volcker rule for proprietary trading, banks trading, making investments with their own money, as this loss in London was a bad job of hedging corporate bonds, which was the house's money, was the bank's own money, and they screwed up their hedging. And Jamie Dimon has said that. Jamie has said it basically was stupid. But the trouble is, stupid right now is legal because the Volcker rule still hasn't been nailed down. The Fed says we got 2 more years, and taxpayers are on the hook, Bill. This is what troubles me as a free market guy, because when taxpayers through the FDIC are on the hook, that's not the free market.
I agree, Larry, and I think that we need to do some things to get the market engaged. For example, Dick Kovacevic, the retired chairman and CEO of Wells Fargo, and I recently wrote an article in the Financial Times in which we called for the regulators to require the major banks in this country and abroad to issue every year, at least annually, a lot of long-term senior and subordinated debt. This will impose some market discipline on these banks. They won't be able to raise that debt, or the price of it will be too high if they're taking big risks, because we won't bail out these long-term creditors. The FDIC just put out a plan this week in which they made it clear they're not going to bail out the long-term creditors. So
Bill, would you
if we
also
do some of these... Go ahead.
I think that the power to come down to Washington and to say, you saw what happened in 2008, you have to save us or you're coming down with us. I oppose those bailouts, but that was an argument that most members of Congress eventually bought, and there's a lot of thinking on Wall Street that if push comes to shove, they will also get bailed out if they're too big.
Dave Schweiker,
Brad, you're making the ultimate moral hazard argument that once you do it, you create the moral hazard that becomes part of the cycle.
That's right.
And Bill, ultimately, wouldn't you want to see the shareholders being the ones saying, look, we're the ones that just took it in the shorts with this bad trade. Now, even though, J.P. Morgan Steel, turned $4 billion profit this quarter on, $100 billion of movement, it's still the shareholders that actually they're demanding corporate leadership.
All right. Well,
provide that discipline.
I got to get out. I got to get out, gentlemen. I beg you. It's a great discussion. I'm sorry we don't have more time. The shareholders did take it on the chin today, but I wonder if lesser banks, I think the world of Jamie Dimon, and I think the world of J.P. Morgan, that there are lesser banks and lesser CEOs that may be running these high-risk trades for the next couple of years, and that puts taxpayers on the hook. It bothers me. Anyway, Bill Isaac, thank you. House members.